Welcome back. Well, for the markets, it's just about consolidating at this point. The mid-cap index is where the action's at. So the mid-cap index is up around 0.3%. There's a little bit of a pickup which has taken place for the Nifty as well, but it's just, up around 50 odd points on an absolute basis. So while there has been a little bit of an incremental shift which has taken place, on an absolute level is just about higher by around 50 odd points. And for the Sensex as well, just about higher by around 130 odd points. The important parameter is the advanced decline ratio, which continues to be on positive terrain. But let's now shift focus to our fundraise segment. And it's an interesting segment that we have where we're discussing the PE and VC investments that we've seen this year, as well as in August. India's private capital markets have witnessed a shifting landscape. And the PE VC investments, in fact, have declined 55% in the month of August, according to reports. And on a year-to-date basis as well, it's down around 16.5%. We have with us Vivek Singla, who is the Managing Partner and CIO Private Equity at InCred Alternative Investments, to discuss this. Vivek, hi, welcome to the show. Well, what is taking place, considering that PE and VC investments have fallen 55% in the month of August on a year-on-year basis, and as well as around 16.5% to 17% this year? Is there trepidation, some amount of cautiousness which is now coming about?
Right. First of all, happy to be here. Thank you. I think you're right. We've been seeing, volumes and value on the, on the deal making front have been soft for some time. Okay. We used to be around $60-70 billion a trade in a year in the last, I think, year or so by 21-22. And that slipped to about $40-50 billion in 23-24. And even this year, I think we are seeing a slippage in the deal value. In my mind, I think there are two large reasons for this. One, I think, coming back from the highs of 21-22, when there was huge amount of focus on growth, I think profitability was sort of pushed back in the corner, and excessive amount of investment happened during that time. But I think as the time has passed, more and more firms have realized that, ultimately the underlying businesses have to perform. And which is why profitability has taken center stage, right? And I think the firms are now waiting and watching for profitability to kick in before writing the checks. So that's number one. Number two, I think if you see what is happening in the public markets for the last 12 months, I think we are finding that there's a bit of sluggishness in the environment, and I think. Some of the big unlisted companies which had a huge fan following in the unlisted domain, they did not perform up to expectations post-IPO. So that also is weighing on the minds of the PE firms before going in. I think they're keeping a bit of margin or buffer before going in. And I think both these parameters, the pricing as well as profitability, are the factors which are driving that, elongated deal making or the process of deal making, which is why you will find the closures have been a little soft.
That's interesting, 59% decline because of the reasons that you're talking about. One, looking at profitability. The second is maybe exits haven't been as lucrative. But at the same time, if you could give us a sense on, whether there is dry powder with the PEs, what is their investable capital versus what is invested? How does that ratio stack up over the last few years? I mean, we just want to understand, because a lot of the family offices, a lot of the HNIs, all of them are looking at private equity as against public equity for as an attractive option right now, or getting much earlier in the line. So from the investable capital that there is versus what is invested, how has that ratio panned out?
I think the fundraising has been still quite robust, if you ask me, the last couple of years. Okay, we find both on the international front as well as even in terms of the domestic flows, the AIF fundraising, etc. There have been a lot of investors who have started, exposing themselves towards the private markets, and rightly so, because this is that market which is likely to deliver that alpha. And I think. the dry powder with the firms, definitely over the last 3 or 4 years, I think we are finding billion-dollar funds have been raised in the market. Investable surplus is definitely high. And at the same time, I think India being such a large opportunity set, the considerations that when it comes to investments are also, I think that set is also fairly large. So I do find that maybe in the near term, you'll find there's a bit of mismatch on the dry powder versus the potential opportunity. But I think that correction is likely to take place over the next 12 to 15 months. So whatever dry powder is there in the market, I think there are ample opportunities in the market which will take care of this dry powder.
Okay, there are ample of opportunities which will take care of this dry powder that's there right now. Vivek, in terms of overall, are we seeing any sort of small deals happening, or even small deals are off the table right now? And what is the sort of delay that is going on currently?
No, deal flow, especially on the small market size, is definitely quite active. Okay. And I find that more and more firms, especially on the early stage ecosystem, they are trying to incorporate elements of AI, right? That is one hot space where, whether it's from the company standpoint or the firm standpoint, those conversations are very active. Okay, so even traditional sector or even the tech sector, wherever I think the conversations around AI, I think that space is very active. Maybe on the large cap side, the large deal making side, there may be a bit of slowdown. But I think that's again a temporary phenomenon in my mind. And ultimately, I find that the last 2 or 3 years have been very healthy in terms of the correction, both in valuations as well as move towards profitability. So from our standpoint, I think things are looking very healthy, if you ask me on the deal.
Just Vivek, wanted to understand how much have IRRs come down on an average, say if you had to compare it to the 2021 or 2022 period and now?
IRR, I think, is a very, the number is too diverse, and, the range is very wide for me to be able to come to you with a particular number.
I'm just asking, in terms of the PE exits and the returns, how much of a recalibration has there been in the past 3 years?
I think the top quartile funds maybe 3-4 years ago would be operating in the range of 25 to 30%. That number today may be in the range of about 20%.
Sure.
If you ask me.
And are you expecting this cycle to change? What are you, since we have seen these kind of statistics for the month of August and year to date, are you expecting a move towards, say, a higher return, increase in PE investments?
Oh, definitely, yes. Like I mentioned, right, this is just a cyclical phase in any industry, right? So our industry is same. What happened in the 21-22 time is just, I think there was excess amount of capital which went in. And that time, I think people maybe at some level lost focus of the valuations or, maybe a little over bullish. But I think the conversations which have happened over the last 12 months, 18 months that we are seeing, I think there's a lot more focus on valuation. There's a lot more focus on profitability. And this is ultimately going to play out in the returns that you'll see coming out in 27, 28. So we are likely to go forward, see that 25-30% IRR coming through, for sure.
Okay. Vivek, just a quick one. You said AI, yes, there is opportunity, but X of AI, where are you seeing opportunity? And also valuations of Indian startups versus rest of the world. How are we standing currently?
So besides AI, I think 2 or 3 things look very promising. Okay. Number one, I think consumption is that one space which really has not performed, if you ask me. This is the largest space in our GDP. But I think for whatever reason, maybe it's, taxes, maybe it's low disposable incomes, etc. And I think government does recognize that, right? So if you see the tax rebates, if you see the GST rationalization, etc., I think they are going to give money back to the consumer. So this is that one sector that is poised to grow. The other is financial services sector. I think the last 2 or 3 years, there was, I think, credit offtake has been slow or the delinquencies were on the high. But I think this is one sector where valuations have been very amenable. And this is the other sector that is likely to grow hand in hand with consumption. And the third sector, especially, is the niche manufacturing or the new age manufacturing, which is the national priority areas like defense and aerospace. So besides AI, I think these three spaces definitely will perform.
Take that point, Vivek. Thank you so much for that. So after the highs, we are now pausing for breath, and maybe once there is enough rest that everyone's taken, both the investors and the opportunities, there would be a match over the next 12 to 15 months. We will obviously keep checking in with you periodically to know where that ball is moving. As of now, it's artificial intelligence, consumption, and some of the niche manufacturing areas where he sees some traction. With that, we'll take a short break, come back, get you more on the markets, the listed markets, that is, because the Nifty is consistently zooming ahead right now. 24,650 is where we are, a 60-point bump up led by the Nifty Bank. At the high point, get you more on markets after this break.